Everyone in retail right now is rushing to use fake AI models to save a buck, but American Eagle just banned them entirely for their Aerie brand, and somehow it translated into an explosive 23% holiday sales surge. You're listening to Earnings Unscripted, where we unpack what actually happened in today's earnings. It is March 4th, 2026, and today we are looking at American Eagle Outfitters, ticker AEO, and their, frankly, wild Q4 results. So, Mira, what is your first read here?
My read is that it is a tale of two realities. Look, the top line was undeniably massive. They hit a record, $1.76 billion in revenue. That is up almost 30% sequentially from Q3. Adjusted EPS printed at 84 cents. But the thing that the thing that shocked me was the balance sheet. They had $210 million in long-term debt last quarter, and they just erased it down to absolute zero in 3 months.
Wiped out entirely, which is, just wild liquidity. And real quick, just to put this out there, this is not financial advice, just our personal opinions. But, Miro, if cash generation is that strong, why did the stock take a hit today? Because they had this gorgeous upward trend all through November and December, peaked in January, but then in extended hours today, it spiked to $24.75 and then just dumped, ended down almost 3% from the regular close.
Because, look, the market always prices the future, and management dropped a massive guidance anvil on the call. They basically told investors that 80% of their entire operating profit for 2026 won't be realized until the second half of the year.
Wait, are you sure that is the exact ratio? 80% backloaded?
80, yes, it is a completely unnatural profit curve because they are front-loading a huge 50% advertising spike plus absorbing this immediate $50 million sledgehammer from tariffs. So they are basically telling Wall Street to close its eyes for the next 6 months.
Yeah, well, Wall Street loves being told to look away. But, I guess they feel confident they can bridge that gap because the consumer demand is clearly there, at least at Aerie. Jen Foyle was on the call talking about this massive trend swing where Gen Z is suddenly dropping baggy clothes for low rises and crop tops, and Aerie is capturing all of that with their activewear.
Right. The Aerie momentum is huge, but it is carrying the whole portfolio. The core American Eagle Heritage brand, those comps were only up 2%. It is dragging the average down. Management is even planning to basically shut down 25 or 30 of those legacy stores just to weed out the dead weight.
Which is a huge structural pivot for a classic mall brand. All right, let's get into the details because I really want to talk about this $80 million logistics pill they just had to swallow.
Yeah, so quiet platforms. Look, this is a classic case of corporate mission creep.
Mission creep is putting it nicely.
Right? A few years ago, they bought this entire logistics network. The grand idea was to offset their own supply chain costs by acting as a third-party shipper for other external brands.
Wait. They were essentially trying to be, like a mini fulfillment service for their own competitors?
Exactly. And it is incredibly capital intensive. When supply chains were completely broken a couple years ago, it probably sounded like a genius boardroom strategy. But operating a logistics service for third parties is a totally different sport than selling denim. So they are finally pulling the plug, just shutting the external service down entirely.
Hence the $84 million restructuring hit, which is a really tough pill to swallow all at once.
It is, but I actually look at this as a massive positive indicator. They are just abandoning the distraction. Jen Foyle was actually reading Jay Schottenstein's remarks on the call, and she read, quote, "As we exit the third-party business, we are left with a significantly enhanced logistics function and a network that will support growth for several years."
Okay, so they basically keep all the expensive warehouse toys, but stop sharing them.
Yes. They solely use the tech for their own internal fulfillment now, and that instantly saves them roughly $20 million a year in operating costs going forward. It is the C-suite finally waking up and realizing their absolute mandate is dominating teen apparel, not logistics as a service.
That makes so much sense. It really comes down to, knowing your actual identity.
which actually connects perfectly to the other thing that really stood out to me, the whole AI model situation.
Oh, right. The unretouched campaign.
Yeah, because almost every other retailer right now is rushing to shave photo shoot overhead by generating synthetic, fake clothing models. It is the big Silicon Valley trend. But Aerie deliberately banned AI for their entire holiday push. They doubled down on their classic Aerie Real authenticity campaign instead.
Which goes against basically everything the tech sector is trying to sell retail right now.
Completely. And Aerie Jen Foyle specifically talked about this on the call. She noted they saw real traction by avoiding AI, saying, quote, "It's a nice uptick to where we were. It actually addresses the new generation." And the underlying metrics back it up entirely. Brand awareness grew 10%, and Aerie's comparable sales crushed expectations with that 23% jump. They realized that adopting fake generative models would essentially destroy their core brand soul.
That is fascinating because from a purely engineering or operational perspective, AI is an obvious margin expander. You cut costs. But from a behavioral perspective, if your entire competitive moat is built on body positivity and realness, generating fake digital bodies is, well, it's just brand suicide.
It totally is. You're stitching the parachute with invisible thread at that point. It just doesn't hold up to scrutiny.
That is a very good way to put it. So they swallowed their pride on the logistics arm to fix their focus, and they ignored cheap tech hype to protect their moat. Underneath all the noisy numbers, it's actually a surprisingly disciplined quarter for management.
I really love that take. So, with all of this massive house cleaning out of the way, plus having exactly zero debt, where does this actually leave their trajectory heading into the rest of the year?
It leaves them incredibly well defended, but practically invisible for the next 6 months. Because, well, like we touched on, they are guiding for roughly 80% of their full year operating profit to hit in the second half of 2026.
Right, which means the optical comparisons for Q1 and Q2 are going to look honestly just atrocious to anyone simply skimming the headlines.
Exactly. I mean, for Q1, they expect high single-digit comps, but only 20 to 25 million in operating income. It is essentially a margin desert. They are voluntarily spiking ad spend by 50% right out of the gate, and they are fully pricing in a $30 million hit from new tariffs immediately.
Wait, on the tariffs, didn't the Supreme Court just stay that whole sweep? So aren't those costs entirely hypothetical at this point?
Yes, and that is the most fascinating part of their modeling to me. They are treating the legal blocks like they do not exist at all. They are locking in the worst-case tariffs into their absolute baseline outlook. Mike Mathias, the CFO, actually joked about it. He said, quote, "We believe the guidance we just gave should be the worst case, knock on wood. I hope I didn't jinx ourselves and the entire industry."
Wow. Okay, so let me get this straight. They wiped out their debt under the radar. They swallowed an $80 million logistics restructuring charge. And now they are aggressively sandbagging the first half of the year with worst-case regulatory assumptions. It kind of feels like they are, setting the stage for a massive upside surprise by Q3?
Pretty much. It is financial armor plating. They are taking all their medicine in one giant gulp right now so they can run completely unburdened when the macroeconomic dust actually settles. I have to say, I genuinely respect it. It takes a lot of nerve to look Wall Street in the eye and tell them you are going to look terrible for 6 months on purpose.
It really does. So I guess the ultimate lesson today is sometimes the smartest tech strategy is avoiding it entirely, and the best financial guidance is just terrifying everybody up front. We will just have to watch and see if they can actually survive the great midriff pivot next quarter. All right, I think that is enough denim drama for one afternoon. If you enjoy dropping in on these chats, you can just follow the show, so new episodes pop right into your feed. And, just a quick aside, we do use AI tools to help piece the podcast together from the raw corporate filings. If there is a specific ticker you want us to look at next, definitely shoot an email to earningsunscripted@datamadness.ca or find the X link in the show notes. Thanks for hanging out, and we will see you next time.